and advise whether the investment is financially acceptable based on financial grounds only. Of course, number 3, number part C says explain briefly, of course, the meaning of what is called sensitivity analysis. So these are a few things we'll be discussing in this session, but also we are being taught to calculate the sensitivity analysis of the investment. So we're going to work it out. Yeah, so these are the things we're going to like, guys, and there's this beautiful topic about discussing the nature. Now see the verb, the word says discuss. The examiner says discuss. It's not saying be biased. No, it's telling you, can you please fairly discuss? Tell me what this is. Tell me what it is, the advantages, disadvantages. Can you give me some examples? What's your conclusion in relation to this company? So you must be in the exam as you are discussing things in the exam. So we are going to go to those ones later on, but in the meantime, let's go with part A. Part A says calculate the NPV, right, of investing in the new machine and advise whether the investment is financially acceptable. So you are going to advise purely based on financial grounds, all right? So guys, there we go. Now let's go. First things first. Like I said, here, what's going to happen is that we have to just make a simple format. The NPV has got a very simple format that we must be able to follow every single time without problems. So here, we've been told in the first place, Warrenco plans to buy a new machine. They are planning to buy, they've not yet bought. So they've come to you, hey, Jacqueline, tell us, what do you think? Should we buy? You say, hey guys, go ahead. No, you don't do that. You first assess it, all right? So the cost of the machine payable immediately is how much? $800,000. So they've told you, right now they're supposed to pay $800,000. And the machine has an expected life of how many years? Of 5 years. There's a full stop. Remember, every time you see that small dot in front of a sentence, stop and think. The machine is how much? 800,000. The useful life is how much? 5 years. Those are not decorations. Of course, you know there's going to be things to do with depreciation and capital allowances and things like that. So you must highlight that number of years and the cost of the machine. So the cost is what we call the initial investment. So the initial investment is how much? Is 800,000. But look at the keyword. The keyword here is this word immediately. All right. So on the format, when we say immediately, we are going to include in year 0. That's why we are going to put 800,000. The word immediately may refer to now. All right. Simply now. So now represents year 0. Don't go and put that investment in year 1. No, that investment falls in year 0. Now, so anything else? Yes, we've been told that the additional investment in working capital will be how much? Will be 90,000. This one will be required at the start of the first year of operation. Did you see that? At the start of the first year of operation, they are going to need how much? They are going to need 90,000 in working capital management. There's a full stop there. Where do you post that 90,000? So don't be in a hurry. All right. Now remember the principle of working capital management. We say whatever you put in business must do what? Must come out. Step to us and be guys. Rule number 1 of investment: don't lose money. Rule number 2: always remember rule number 1. There are only 2 rules of investment. All right. Of course, according to me. Okay. Yeah. So at the end of 5 years, the machine will be sold for scrap value, with the scrap value expected to be how much? 5% of the initial purchase. Look at that. This machine at the end of 5 years will be sold. Of course, there'll be scrap value. When working out depreciation, please remove the scrap value first. All right. Do not depreciate the scrap value. That's common sense. And then the scrap value will be 5% of the initial purchase price. What is the purchase price? 800,000. 5% of that, my memory saves me, that should be 40,000. 1, 2, 3, 4, 10, 10, 80. 40,000. Yes, 40,000. Yeah. So you can do that on your calculator, but 5% of 800 is 40,000. All right. Oh, I'm so good at percentages. Can you believe that? So what we have here, guys, is that, of course, production sales from the new machine are expected to be 1 million. But notice this 40,000, the purchase price, will be subtracted in what at the end of the period that has been given to you, 5 years period. After 5 years, you are going to remove how much? 40,000. In year 5, you're going to be the scrap value. So after 5 years, you're going to subtract 40,000 from the what? From the total, of course, figures for a 5. So we've been told again that production sales from the new machine are expected to be how much? Look at that one, 1,100,000 units per year. So each year, these guys will be selling how much? 100,000 units. But think of it this way, guys. Each unit can be sold for how much? For 16 kwacha per unit. Can you believe that? I think this is fantastic. So 100,000 units, 16 kwacha per unit. That's about how much? That's about is it 1.6 million? All right.
Yeah.
All right. Yeah, 1.6 million. Per unit, and will incur variable cost of how much? Of about 11 kwacha per unit. That's about 1.1 million. Can you believe that? So of course the variable cost of 11 kwacha, that means you're going to have a contribution of how much? Of 1.6 minus 1.1, which gives you 500,000. I think that becomes easier. Okay. Then there's this other young lady here. Incremental fixed costs arising from the operations of the machine will be 160,000 per year. Incremental fixed costs. Remember, fixed costs when we did the skills level, level 2, we are told fixed costs are fixed, costs that do not change. That was a lie, okay? That was just taught to you when you are starting so that you don't ask too many questions, all right? But as you go up, you're going to see that actually in the long run, fixed costs do change. So incremental fixed costs, these ones are relevant costs because they are increasing as a result of our decisions. That is what we learned in management accounting, all right? Performance management. So this 160,000 per year is going to be extremely relevant. Now, we've been told that Warren Co as an after-tax cost of capital of how much? Of 11%. Guys, I always say in this class, if you are going to borrow money and invest it, remember the cost of debt should not be more than the return. Is that okay? If you are borrowing at 11% and then your return is 9%, what are you doing? Your return should be higher than your cost. That's the whole principle. And you're going to learn this more when you begin to do the work. All right. So 11% is what they use for as a discount rate in investment appraisal. Okay, so we are going to discount these things using 11%. So the company pays profit tax 1 year in arrears. What that means, it means, and it makes sense. You guys have done taxation, you guys have done financial reporting. What did we learn about IS number 10 financial reporting? We learned that there's what is called deferred tax. All right, partly because there's a difference between when taxes when the taxes are actually incurred and when it is actually paid for. There's a timing difference. So the taxman, when you sell on credit, you're going to recognize what is called sales, and then you remove your cost of sales, you have your profit. So you're going to make an estimate on that to pay tax. But the taxman from the other comes and tells you, know what, I'm not going to get money from you because what you have is not money. These are simply numbers on a piece of paper. So I'm going to wait for you to receive that money next year or whenever you're going to do, then I'm going to tax you. So there's a difference, or it's called timing difference, temporal difference. That's why we have deferred tax, tax being paid at a future date. So all these things are going to be, of course, discussed. All right. So the company pays profit tax here 1 year in arrears. That means if today you are supposed, let's say you sell goods worth 100,000. Here's what I mean by that. Let's say today, guys, you are selling goods worth 100,000. So according to you, you've sold goods worth 100,000. You see that's worth 100,000. So according to you, you've recorded a sale in your books. All right, in your books, what you have is a sale. So what are you gonna do? According to you, if you remove maybe the cost of sales and things like that, let's say your profit is how much? According to you, when you remove the tax at 30%, all right, your tax is about 30%. In this country, we pay 30%. That would be about 30,000. All right, that would be 30,000. So we remove that figure, okay, from there, and here's what we are going to have. We initially are supposed to have a profit of how much? Of course, 70,000. That is the idea. right? Supposed to have profit of 70,000, but the problem that we will not record 70,000. Instead, we are going to record something that will look like this. We have 100,000 somewhere here, and then here on tax, can you believe that we have 0, and on profit we have how much? 100,000. Why? Because of a simple reason. Have you seen? You are the owner of the company. You've sold goods on credit with 100,000. So according to you, multiply by 30%, you're supposed to pay tax of what? Of 30,000. And then your profit should be 70,000. But the tax man comes to and says, you know what, Jackie, I'm not going to get this money from you. Partly because this 100,000 which you have here is not real money. It is simply a number on a piece of paper. I'm not going to tax a number. So the taxman says, you know what, I'm going to wait. You will give me, I'm going to charge you tax the day you receive actual cash. Have you seen? So now, in the end, in your books will look something like this here. Have you seen? You are going to have a profit of 100,000. Now, notice this is going to pose a lot of confusion, partly because the shareholders, when they see 100,000, then they are excited. They want to share dividends. So how do you do it for them to know that this 100,000 contains some money which does not belong to them? You're supposed to show a deferred tax figure on the SFP so that they know, okay, we are owing some people so much. Out of this 100,000, it's not everything that belongs to us. That's how you do it. Now, so tax, that means if you sold in year 1, all right, if this was year 1, that means you're not paying tax in year 1. Somebody's paying you tax when? At the end of the year. So you're going to pay tax in year number 2. When money is received, that's when you're going to pay the tax. That is why tax is always paid in arrears. So this 30,000 is going to reflect when? In year number 2. That's why it's going to appear. That's why it's going to be payable. So tax is always paid in arrears. Always paid in arrears. Always. All right, guys. So I hope you guys have seen that. So okay. So I hope you guys can see that. Okay. So there we go. So what we have here, guys, we have now, of course, the annual tax rate is 30% per year, and then capital allowance and inflation should be ignored. Can you believe that? I think this exam was just an awesome one. It says, you know what, guys, I like you so much, but I want you to know that ignore capital allowances and depreciation, but because you know what, I don't care. He says that directly to you. Can you believe that? Yes, we can. All right, guys. So let's make the format. Let's make the format. If you have a question, feel free to ask me. That's my job, okay? I'm happy to repeat what I say as many times as I can, okay? That's my job. So let's make the format for part A. Okay, so part A, I'm going to name this one, of course, Warren Co. All right. Good. So what's the format? The format here, we do the same normal format. Can you see from the question, we have sales, we have variable cost, we have contribution, we have fixed cost and things like that. So what we do, simply bring the sales, okay? The same way you've always done it. You bring the sales here. But of course, before the sales, we have what is called, of course, the year, right? You bring the year here, and then you have, of course, what is called year number 0. And then you have year 1, year 2, year 3, year 4, year 5. But you know, we are going to add an extra year. Who knows why we're adding an extra year, guys?
Sir, is it because of the deferred tax? Yeah.
Very good, because of tax. You're supposed to pay tax in 5 years period, but notice tax for year 1 is going to be paid when? In year number 2. Tax for year 2 be paid in year number 3, for year 3 in year number 4, year 4 in year number 5 in year number 6. So you're going to have an extra year. So always, because of tax, we add an extra year. All right, you guys are awesomely fantastic. Okay, so there we go. So we have that, and boom, there we go. So we have the years. Now, after having the years, what do? We have what is called the investment. If you like, you can bring the investment part, because for me, I would like to bring the investment, of course, in year number 0. So what is our investment, guys? All right. What is our investment? The investment is simply the cost of the machine, okay? The cost right now, we are being told the cost is how much? Is 800,000, okay? So I'm gonna remove the zeros. I'm just gonna put, of course, 800,000, 800 kwacha there. So that, but of course on top, I want you to know that there are zeros. Maybe I can do something like this. I can put zeros on top, yeah. So you guys can, I should have put them at a better none, but I'll just say maybe these ones are here, like something like that, or we can put a dollar sign there and things like that. Yeah, we can do something like that. Oh, yeah. So just to remove that. So that is the cost is 800,000. Okay. Now that's the initial cost. But again, there's something else I want you to understand about tier number one. In the number one, we are being told there was what is called working capital. All right. So working capital for a number one, how much was it, guys? That was working capital for a number one of how much?
Of 90.
Of 90. Very good. Have you seen? There was working capital of 90, of course, in year number one. So year number one contains a working capital of 90. Okay. This is the working capital. So what do? You show it there. Okay, so there we go. After the investment, we pumped in how much? We pumped in working capital of about 90. Remember, here's the amount that you're going to pump in. Then anything else that you have been told? Yes, we've been told something very interesting. We've been given the cost of the machine. We've been told about the working capital. And now we're supposed to bring in these things. Supposed to bring something called the sales, all right? Sales. The sales, then of course the variable costs. And of course, after the variable costs, we are going to have something called contribution. So let's go. What is our sales, guys? Now, you have to understand something here. You can do a quick calculation if you like, all right? You can do a quick calculation if you like. But I'm not going to waste time doing that calculation. But for the purpose of learning, I'm going to show you. So for the sales, instead of us working them as per unit, because we know of course that the sales price is how much? Is 16 kwacha, right? $16. Look at the sales price, $16 yes. Per unit. The variable cost 11 per unit. How many units do we need? 100,000. So what I'm gonna do, I'm just gonna put the total value. All right. Instead of us working on 16 times the what is the cost per unit, and then we begin to put, I'm just going to bring the total. What is 16 times 100,000? All right. So we're going to make sales of how much?
16.
Sales of 16. Right. That means our variable costs. How much our variable costs, guys?
1,100.
1,100. Very good. Yeah. So that is for year number one. But notice, guys, did the examiner tell you that everything is going to change? No. The examiner said inflation must be what? Must be ignored. Now, this is a good thing, but because you have the fixed price for all the years, 16 per unit, and you incur variable cost of 11 kwacha per unit, full stop. Nothing else has been added to this statement. That means the price is the same for the all 5-year period. So here you're supposed to jump. What do? You simply, you know what, guys? I'm gonna do something like this, okay? I'm gonna bring this one here, 16, again 16, again of course 16. You go there, you put your 1,600, and then you still do the same for what? For variable costs. Remember, these are costs, all right? So what do? These are costs. You must demonstrate that these are costs. Of course, you have to demonstrate these are costs and things like that. You have to demonstrate these are costs and things like that. You have to demonstrate that they are costs. So if you have a question, feel free to ask before we go any further. So there we go. So we have those costs. Then what do we do, guys? Next, what we have is contribution, all right? So how much is our contribution, guys? Contribution of how much? Of 5 jali, right? So we have 5 jali, 500, 500, 500, right? That's our contribution. Yeah, so I'm just gonna do this. Yeah, so we have a contribution of how much? Of 500. Okay. Now notice what we are told. We are told that there is what is called incremental what? Incremental fixed costs. So we have the fixed costs, guys, here. How much our fixed costs? What is the incremental cost? We are told that it's how much? 160,000 per year. This figure here, 160,000 per year. So what do we do? Of course, we come here and then we say fixed costs are 160 per year. These are costs. You have to demonstrate that, of course, you're dealing with costs. So 160, we come here again, we do the same, 160. We remove again the same thing, 160. These things are so sweet, guys. If you're just relaxing the exam, man, you're gonna enjoy them. 160, and then there we go. We have about 160. Boom. All right. So after we have all those costs, the next figure that we are going to have is now we're supposed to pay tax before we have our profit. All right. We're supposed to pay tax. So we're going to have something called taxable cash flows. All right. So we're supposed to have something called taxable what? Taxable cash flows. Okay. So there we go. Those are our taxable cash flows. So how much will be our taxable cash flows, guys? Our taxable cash flows will be how much here? 340, right?
340.
Yeah. So what we have here, we have 340. 340. 340. 340. 340. Those are taxable what? Taxable cash flows. So now that we know what we are paying in what we're going to be taxed, then we remove our what? Our tax. All right. What's our tax liability? Now you remove the tax liability. Of course, remove the tax. How much is our tax, guys?
30%.
30%. Very good. We are told tax is 30%. 30% of what?
30% of taxable of taxable cash flows.
Yes, tax is 30%. So what is 30% of 340? The easiest way to work out a percentage is simply multiply by 10%. All right, and then multiply by 3. So that gives us about how much? 102. Yeah, 102. That is the fastest way. That's how I do it myself. Simply multiply by 10, then multiply by something. It's faster as well. So what do you do? We have 102. Now notice tax is always paid when in arrears. So here we put 0. Then the figure for year 1 goes to year number 2, 102. As you see now. So we have 102. There we go. We have 102. There we go. We have 102. There we go. We have 102. Now the other one now makes sense for a number what? A number 6. 102. That is the reason why we do that. Okay. So you must understand that. Anything else? What do we do next? Next here, we are going to have something called, of course, after tax cash flows. This were taxable cash flows. Then we are going to have after tax cash flows. Or sometimes you can not even put the title. You can just bring in something, something else like working capital and scrap value. All right. Yeah, you can bring working capital and also you can bring in the scrap value. But just to follow once you get used, you will not be putting some of these headings. All right. But in the meantime, for the purpose of learning, I'm gonna put them after tax cash flows. I'm gonna put them for the purpose of learning. So after tax cash flows here, what we have of course 340, right? And then here when you less, you're going to have about 238. 238. Then here, of course,
368.
Going to have 1,
368.
What? Which one?
This year number 5. Year number 5. Is it not supposed to be 368?
Why?
I think my calculator shows me that. I don't know.
Your calculator is sick. My head is better than your calculator by far. Anyway, it can't be better. It can't be better than my head anyway. I made the calculator. So your calculator is sick, and it should be called for what it is. Okay. Your calculator is sick.
Okay, I get it, sir.
Yeah, I knew it. I knew it. Your calculator is sick. All right. Very sick.
Yes.
I knew it. How did I know? So guys, what we have is that we have, remember what we are told again, but what is going to happen towards the end? We are told there's going to be...
Sambo.
Yes?
Just the after-tax cash flow in year 6. The 102. I think I'm not clear on that one.
Oh, you're not clear on the 102?
No.
No.
Tax.
Right, guys, who knows, who can explain to Mr. Chikwanda why the 102 is there?
I think it's because tax is paid in arrears. So the tax for year number 5 will be paid in year number 6.
Look at tax for year number 1. There's 0 here. Can you see that? Here, there's 0. Tax is being paid in arrears. So tax for year 1 goes to year number 2. Tax for year number 2 goes to year number 3. 3 go to 4. 4 go to 5. 5
no,
go to
no. I meant the after-tax cash flow.
Yes. Your eyes are also sick. Let's call them for what they are. Okay. Your eyes are sick. We need to call them for what they are. If you less 0, you remove 102 from 0. What are you going to remain with?
Okay. No, I get it now.
Your eyes are sick. All right. Extremely sick.
No,
so
I didn't want to make an assumption. I wanted to understand why you
no way, that's sick. I'm just gonna put zeros here.
Oh, you just add, okay.
Right? So I'm gonna put zeros like that. Are you happy like that?
Very happy now.
Get those. Guys, I think that's fantastic. That's a good one. So I've just put zeros for the purpose of Mr. Chikwanda to see where the 102 is coming from. Okay, can you believe that? I'm such a nice man. So guys, now next we are told something here. We are told here that look at it this way. We are told that this guy is gonna put 90,000 in working capital management. All right. Remember the rule of working capital. Rule number 1. What did I tell you guys? There are 2 rules of investments. Rule number 1. What did I say? According to me, rule number 1. On the 2 rules of investments, guys. Rule number 1 is very good. Don't lose money. Rule number 2.
Remember rule number 1.
Very good. So rule number 1, we had put in 90,000 in working capital, but we can't lose that. It must come back at all cost. You must remember that. So guys, let's go. So in year number 5, what we put in must come out. Okay. So we are going to remove what's working capital. All right. So in number 5, of course, we're moving working capital. How much? How much did we put in? We put in 90. All right. So in year 5, we come and remove our 90. It must come out. Now this time around is not a cost. It is our money that's coming back to us. And then we are told something else, that there was a scrap value, right?
Yes.
Of how much? 5%, right? Of the investment, which is 5% of 800. It's about how much? That is 40,000, right?
Yes.
We remove that 40,000 there. Let's come back. It is not a cost, it is money. Don't put that. Okay. So now after we do this, we're now going to have our net cash flows. That's because there's nothing else. Please mute yourself. There's nothing else that you have been told by the examiner. So what is our net cash flows, guys? Here, look at that one. Here, we have how much?
340.
340. And then here, how much we have?
238.
Very good, 238. Next, 238.
238.
Next, 238. Here,
368.
very good. Yeah. So guys, and then here, of course, we still have the same guy, right?
102, yes.
So that's our net cash flow. Okay. That's our net cash flow. So now look at it this way. So our net now becomes how much here? Is 890, right? Okay. We have 890 there. You see that, guys?
Yes.
Just so you know, for the zero line. So I've just put it there just so you know. You have 890 there, 800 plus 90. So now there we go. So what do we do next? Now we were told something by the examiner. The examiner told us something. He said, you know what, guys? I need you to discount this using what percentage, guys? There we go. He said 11%, right?
Yes.
Yeah. So we're going to use 11% as a discount rate. 11% as a discount rate. Now, there's always a guy who has no idea what a discount factor is. Okay. There's always a guy who has no idea what a discount factor is. There's a PV table. You must have a PV table. I think I told you from day one that in this exam, you must get used to using a PV table for you to pass this exam. So we are going to use our PV tables now to discount these cash flows so that we can get our net present values. So now let's go here. Our discount rate has been given to us as how much? As 11%. All right. So the discount factor, of course, at 11%. So what we do here, for a number 0, it is always what? 1. What is the discount factor at 11% for a 1?
0.901.
0.901. You guys are awesome. Year number 2.
0.812.
812. You guys are the best. Number 3.
0.73.
731.
731. Number 3 starts with 0. How do I know? Yes, guys.
0.59.
0.659. Number 4 starts with 0. I can prophesy. How do I know I'm such a genius? Number 5. Number 4. Number 5.
593.
593. Oh, you guys are awesomely fantastic. Number 6.
0.5535.
You guys are the best. Can you believe that? So now what we now have here, we are going to have something called our what? Our present what? Present values. PVs. Right? Our present values, PVs. So what is our present value here? 890 times 1?
890.
You know what? I don't know. I don't know. We never learned how to multiply. There's always a guy who is just confused. Say, what is our figure for a 1?
301.
306.
306 because of that.
Yes.
1. Year number 2.
193.
193. You guys are awesome. Number 3.
174.
174. You guys deserve an award. Number 4.
157.
157. You the best. Number 5, guys.
218.
218.
18. Fantastic, guys. Let's clap for this man. He's such a wonderful man. Number 6.
Negative 55.
Awesomely fantastic. Can you believe that? You are a genius. So now, guys, we have the PVs. Okay, so we have our PVs. Can you believe that? We have our PVs. So what do we do next? We get our NP, our NPV. NPV simply means now the total, the net present value, the total value. Okay, so let's get our NPVs now. Okay, our NPVs now is going to be something like this. What is going to be our NPV, our total value? So our total value will be simple. All we do, we are going to say 306 plus 193 plus 174 plus 157 plus 218 minus 55 minus 890. How much is that?
103.
103. Yes! Yes, 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 yes. You are the best. You are the best. Can you believe that, guys? The NPV is how much? Is of course 103. So what I'm gonna do, I'm gonna delete this one, and I'm gonna come here. I'm gonna say NPV is of course NPV is of course. So what you can do, you can simply say 103. But for the purpose of learning, I would have loved somebody to tell me what is 55 plus 890. That's for the purpose of learning. 55 plus 890. How much is that?
945.
We have 945. And then we remove how much from 945? 306 plus 193 plus 172 plus 157 plus 218. How much is that?
$103.
No. 306 plus 93. 193 plus 174 plus 157 plus 218. How much is that?
1,048.
1,048. All right. Yeah, that's what gives us how much 103 as NPV. As NPV. As NPV. Okay, so there we go. So guys, is there anybody with a question before I give you another way of doing this? Okay. Is there anybody with a question? Is there anybody with a question? I'll send to them. Is there anybody with a question, guys? Anybody with a question, a contribution? Anybody, guys? Or just somebody who wants to clap for me for just being such a wonderful man? Can you believe that? I think I'm such a wonderful man. Can you believe that, guys? I'm so wonderful. Anybody who's not clear, tell me now that I'm not clear. See how wonderful I am. All of you are clear. Can you believe that? Wow, I'm so wonderful. Such a wonderful man. Everybody's clear as a cucumber. Guys, any question, any contribution? Shouldn't say. I don't know. Okay. All right. Okay, guys, thank you so very much. Thank you so very much. If there's no question, I want you to know that that's how you work out the NPV. All right. That's how you work out the NPV. So, guys, are you clear? Mwenya, do you want to clap for me for being so wonderful?
I'm clapping. But then when I was reading When when you were reading out the message, there was the question. There was that part that said incremental fixed costs. So obviously this is the examiner trying to confuse us, because we know that a fixed cost is just a fixed cost. Now to put incremental, like it's going to be increasing every year or something like that.
Oh, okay. So incremental fixed cost arising from the operations of the machine will be 160 per year. Have you seen that? Will be 160 per
year.
Per year. How many years are involved in here?
5.
Each year will about how much?
160.
160. That is where that 160 is coming from.
Yeah,
If
I know.
Yeah?
I know where it's coming from, but I was just saying for them to just put the word incremental, obviously it's to confuse us.
Yeah. The examiner understands that students, they know that, no, the word incremental is not to confuse you. The word incremental is to let you know that these fixed costs are different from normal fixed costs. If the examiner just said fixed cost will be 160, it could have been irrelevant, all right? Because fixed costs are irrelevant cash flows. That's what you learned. But fixed costs become relevant when they are incremental. You know what that means? It means that you are incurring this cost specifically because of your decision right now. So that cost is going to be what is going to be important. It is an incremental cost from what you already have. Now, because you're undertaking this project, you have an incremental cost on top of what you already have. So the incremental is what you're going to account for. What you already have, that doesn't matter. Let me give an example, because I'm just such a wonderful man. Let's say that you live alone. This is Mwenya lives alone. All right. So Mwenya lives alone. Okay, can you believe that? So Mwenya, you live alone, and your rent amount is about 2,000. Okay. So let's say you pay 2,000 kwacha as your rent amount. Is that okay? Yes. And then your grandma from the village gives you a call and says, what, Mwanya, your grandpa is not feeling too well. We want to come to the city because there are nice hospitals. We want to come and stay with you. Right? And then because we love your grandpa and your grandma, you tell them, okay, fine, you can come. But you've not told them that you live in a one-bedroom house. So this 2,000 is what you pay for what? For a single bedroom house. Can you believe that? So this one you paid for a one bedroom house. One bedroom house, you pay that amount. But when your grandpa and your grandma comes, you don't want them to be sleeping in the living room. So what do? You go and rent a 2-bedroom house. Have you seen that?
Yes. You
go to rent a 2-bedroom house because you want your grandpa and your grandma to have some privacy. Now, notice how much are you paying here? So your rent amount has now changed. All right. Your rent amount has now changed to how much? To kwacha 3,500. Have you seen?
Yes.
That means you have an incremental cost of how much? Incremental fixed cost of how much?
1,500.
Kwacha 1,500. Can you say this cost is irrelevant?
No.
Why? Why? Why, Mwenya? Why are you not saying it's relevant? Mwenya? Why?
Because it's part of the rental amount. So it's irrelevant. For you to be in the 2-bedroom house, you need it. You need to pay.
Because it's an extra cost you're going to incur for your decision to host your grandpa and your grandma. You're incurring it because of your decision. Why are you not counting a 2,000 as a cost? Why? Guys, who can tell when Mwenyewash is not counting in 2000 as a cost? Guys, who can tell Mwenya? Who can tell Mwenya, guys, why we can't count this one as a cost? The 2000. Guys.
Sir.
Yes.
It's because it's subjected to changes from time to time. It's variable.
Because it's done what?
Because it's expected to change from time to time.
No. You guys are lost, like lost.
Can I try, sir?
Shame on all of you guys.
Can
Shame
I try?
on. Yes, Nastere, let's go.
I think that 2000, it was incurred in the past, but this time, when I was thinking of an alternative, which is the 2-bedroom house, and that makes the 1.5, the 2000 as a sunk cost. I don't know in that way. I'm thinking of relevant costs.
Yeah, you don't know. You're right. You don't know. Get lost. Get lost. So guys, the reason why this 2000 is extremely relevant is partly because whether the grandpa comes to live with Mwenya or they don't come,
still be there. Yes.
Still pay the 2000. It doesn't matter. It is not affecting her decision to host her grandparents. It's a fixed cost that she pays, whether she's alone, whether she's with somebody, she'll still incur this cost. Either ways. But the 1.5 becomes important, but because she's incurring this cost because of the new decision that she has made to host the grandparents. If these parents are not going to come, she won't incur it. Have you seen her? Naturally, can you see that?
Yes, sir.
Fantastic. Was that so hard to see? Was it so hard?
Yes.
Jackie, talk to me, my friend. Was that so hard? Jackie, you've neglected me. Was that so hard?
It was not hard.
Jacqueline got lost. So guys, that was it. So I want to appreciate you for being here. Thank you so very much for today. So look at it this way. We're supposed to look at this other question, but I want you to practice what you have looked at, okay? So as we meet tomorrow, we are going to finish up. Okay, let's do this. I want to give you another question to practice what you have talked about, and then we'll finish up the question. Okay? Yeah. So yes.
Can you share this question on the group, on the WhatsApp group?
Yes, I'm gonna share the question on WhatsApp. Yeah. So guys, are you okay? Is everything clear now? Are you fantastic? Are you happy with the calculations, with the NPV, how to do it? Are you happy with that?
Yes, sir.
Okay.
Yes, sir.
All right. So now, what I want you to tell me now is this. Remember, we're asking the question that you're supposed to advise whether this project is financially acceptable or not. Let's advise. Look at the numbers, guys. What do you think? Based on your findings, do you think you can advise this client to go ahead and invest in this new product, this new asset?
Yes.
Yes,
Yes,
sir.
Yes, sir.
It has given a positive NPV, so meaning the business is viable.
Very good.
Yes.
It's
What does
financially
a positive
acceptable.
NPV mean?
The project, the business is worthwhile, and it will increase the shareholders' wealth.
Okay, now you are talking. I was almost telling you to get lost, but after adding the last part, I think I'm happy with you. Okay, that's fantastic. It means today, if you took that project, the shareholders will be worth by 103 million. Okay, yeah. What it means. So if you look at now, what are the advantages of an NPV method over other methods? If you look at what we have done, guys, what do you think is the advantage of using an NPV method as compared to other methods? Tell me, what do you think?
It takes into account the time value for money.
Very good. It takes into account the time value of money. Number two?
It looks at cash flows.
It looks at cash flows. So if you say that, we have to graph for you. Like, seriously, we have to graph. Guys, tell me something. What is the good part about the NPV method? From what we have seen in the calculations, tell me, what is the good part about it? Guys, what is the good part about the NPV method?
The shareholder wealth is maximized.
You need to sleep. You need a lot of sleep. Anything else?
Or shareholders benefit when the NPV.
You need to go to sleep like right now. You need to sleep, my friend. I know you're tired. Yeah, you need to sleep. Yeah, you need to sleep. Anybody else, guys? Guys, I'm asking you a direct question, all right? I'm asking a direct question. Okay, what I'm gonna do, I'm gonna give you a chance to read through the notes, and then we'll discuss. I want you to write a report to me and tell me 5 good things about 5 advantages of the NPV method, and then 5 disadvantages of the NPV method. And also tell me how the NPV is better than other methods of investment appraisal, like payback, internal rate of return, you know, what is the other one? Account rate of return. Tell me how the NPV is better than those other ones. All right, 3 things, and then we'll come and continue with the question. Is that okay? That's okay, guys. Right, good. So guys, I'm gonna leave now. I'll expect that report today. All right, so I'll leave you now. We still have about 23 minutes before the session ends. So I'm giving this 23 minutes right now for you to be able to write a report to me, the CEO for SLPLC, and tell me the advantages of the NPV method, 5. The advantages of them, 5, and also tell me how the NPV is better than the payback, account rate of return, and the internal rate of return. Tell me. The report should be well written. Okay. Yeah, you have to submit before 12:10. So you have 23 minutes from now. Okay, guys. Thank you so very much. You can grab for me if you like. I'm gonna see you soon. Okay. So I'm just going to mute myself. Don't leave the platform, stay here. I'm just gonna now stop the recording and I'm gonna mute myself. Thank you so much. Bye-bye.